Welcome to TalkTickers. Today we're diving straight into the essential takeaways from Datadog's Q1 2025 earnings call. Definitely aimed at you seasoned investors out there.
Yeah, it was quite a strong quarter on the face of it. Lots to unpack.
Absolutely. So let's get started. What was the big headline number?
Right. The headline was revenue. Came in at $762 million. That's a solid 25% increase year over year.
And that beat their own forecasts.
It did, yeah. Exceeded guidance.
Yeah.
And they also grew the overall customer base pretty significantly, up to around 30,500.
Okay, more customer, always good. But I'm always interested in those, the higher value clients. What's the story there?
That's definitely a key metric for them. Customers with an annualized revenue run rate, ARR, over $100,000. That number grew to about 3,770.
Okay.
And importantly, that group now drives something like 88% of their total ARR.
Wow, 88%. So yeah, as you said, the big fish are really, really crucial for Datadog.
Exactly.
And how about efficiency? Were they just spending to get that growth, or is the operation looking healthy?
No, efficiency looks good too. Free cash flow was strong, came in at $244 million.
$244 million. What does that work out to as a margin?
That's a 32% free cash flow margin.
Yeah.
So, demonstrates really strong cash generation capabilities alongside that growth.
Okay, so growing well, generating cash, that's a good baseline. Now, about those customers, are they just dipping a toe in with one product, or are they really embedding Datadog across their systems?
That's another strong point. Platform adoption is definitely increasing. You can see the value of their integrated approach there. 83% of customers are using 2 or more products now.
83%, that's high.
It is. And it gets deeper, 51%, so over half use 4 or more. 28% are using 6 or more, and even 13% have adopted 8 or more products.
That really suggests stickiness, doesn't it? Once you're using that many products, switching costs must be pretty high.
Absolutely. It speaks to a compelling platform value prop.
Were there any newer products that particularly stood out this quarter, showed real momentum?
Yeah, a couple definitely worth highlighting. Flex Logs has scaled incredibly quickly. It surpassed $50 million in ARR in just 6 quarters.
6 quarters, that's rapid.
Very rapid. Shows strong demand there. And database monitoring is another one. It's getting close to that $50 million ARR mark as well.
And growth there.
60% year-over-year growth, and over 5,000 customers are using it now.
Okay, so the innovation engine seems to be working, translating into real adoption. What about winning new business, especially those larger deals?
Overall, it was a strong bookings quarter. New logo dollar bookings were up over 70% compared to Q1 last year.
70%, that's quite an acceleration.
It is. And what really caught my eye was the jump in large deals. They signed 11 contracts with a total contract value, TCV, of $10 million or more.
11. What was the comparison last year?
Just one in Q1 last year.
Wow. Okay, that's a massive shift. Really signals increasing traction way up market in the enterprise space.
Definitely. And on the flip side, how are they doing keeping the customers they already have?
Retention remains solid. Gross revenue retention is stable, sort of in the mid to high 90s.
Which is what you want to see, right? Low churn underscores how critical the platform is for users.
Exactly. Okay, so that gives us a really good snapshot of the results. Let's dig a bit deeper now. What's driving this? What were the key platform and product highlights investors should be aware of?
Well, a huge theme, unsurprisingly, is AI. They're seeing a lot of customer interest in next-gen observability and analysis, specifically for AI.
Makes sense.
Over 4,000 customers are now using 1 or more of their AI integrations. That's doubled year over year.
Doubled, okay.
And their specific LM observability product, which is key for watching AI model performance, adoption there has more than doubled just in the past 6 months.
So they're really positioning themselves for this wave of AI development and deployment. How are they actually, using AI within their own tools?
Good question. They're enhancing their Beats AI, adding things like workflow automation and an app builder using what they call their Next-G AI.
And the goal there is?
Faster issue remediation, ultimately moving towards auto remediation.
Sure.
Making the platform more proactive, less reactive.
Okay. And alongside that AI push, they mentioned security quite a bit too, right? DevSecOps?
Yes, huge focus there. They're continuing to invest heavily in their security product suite.
It seems like that portfolio has gotten quite broad. Can you give us a sense of what's in there now?
It was pretty comprehensive. You've got vulnerability management across software, infrastructure, cloud security that finds issues in hosts, containers, Kubernetes, even infrastructure as code.
And they have agentless options there, I saw.
Yes, agentless scanning options, which is important for some environments. Then there's code security, looking at first and third-party code vulnerabilities. That one's got over 1,000 paying customers already.
That's decent traction.
Yeah. And then threat management, which includes cloud SIEM, workload protection, app and API protection. And finally, their sensitive data scanner.
What does that do?
It discovers, classifies, and can redact sensitive data across different data sources, even, interestingly, within LM prompts. Helps manage risk there.
That's a very wide security net they're casting. How is the adoption looking across the customer base for these security tools?
Pretty strong. Over 7,500 customers are using at least one security product. That's about a quarter of their total customer base.
Okay.
And maybe more significantly, it's over half of their Fortune 500 clients. So really good penetration in those large organizations where security is obviously top of mind.
That makes sense. Seeing strong enterprise uptake there is a good sign. Any other strategic moves? Geography, acquisitions.
Yeah, on the geographic front, they're planning a new data center in Australia. That's to meet local needs around data residency, privacy, security. Pretty standard expansion play.
Right.
And on the acquisition side, two interesting ones announced recently, EPO and Metaplane.
Tell me about those.
EPO is a feature management and experimentation platform. Think enhancing release speed, product analytics. Metaplane is a data observability platform, focuses on data quality, availability issues.
Data observability. That sounds quite strategic, especially with the AI focus.
Exactly their thinking. They plan to integrate Metaplane into their existing data observability offerings. They see robust data observability as pretty crucial for enterprise AI workloads to actually succeed. You need reliable data feeding those models.
Makes perfect sense. Those acquisitions look like smart, targeted additions to the platform. Okay, let's shift gears slightly to sales and marketing. Any specific customer wins or expansions that really stood out this quarter?
Yeah, they highlighted several big ones. A major U.S. car manufacturer signed a 7-figure ARR deal. They're aiming for unified observability across a complex hybrid setup.
Hybrid is still key for many, isn't it?
Definitely. And they started with 13 products right off the bat, consolidating about a dozen different tools.
13 products. That's a big platform commitment.
Huge. Also, a major Latin American bank, another 7-figure ARR deal. Their focus was reducing operational costs, enabling more departmental autonomy. They started with 6 products, replacing 3 others.
Interesting drivers there. Cost savings and autonomy.
Now, one more big new logo example. A major American pet supplies company, also 7 figures ARR. They actually expect to save over $1 million annually by switching.
How many tools are they replacing?
They're adopting 11 Datadog products and replacing 7 commercial tools plus some open source. So clear ROI story there.
Absolutely. Those are strong examples of landing new, large customers with clear value propositions. What about growing existing accounts? Any notable expansions?
Yes, expansions look strong too. An insurance tech customer came back, signed a 6-figure ARR deal, cited ease of use, the out-of-the-box capabilities, planning to adopt 10 products.
So a returning customer, happy with the experience, good sign.
Very. And then a major U.S. health insurer expanded significantly. They're now using 17 products.
17.
Yeah. And reporting really dramatic reductions in mean time to resolution, MTTR. Like one example went from 3-4 hours down to 3-4 minutes.
That's the kind of operational impact that justifies the spend.
Precisely. And one more. A leading next-gen AI company expanded to 7-figure ARR. Their goal was reducing tool fragmentation, tool sprawl. They adopted 5 products, replacing their commercial APM and log management tools.
So consolidation and efficiency gains are recurring themes in both new wins and expansions.
Definitely. Customers are seeing tangible benefits, whether it's cost savings or major operational improvements.
Okay, stepping back a bit, what's Datadog's sort of longer-term view on the market opportunity?
They sound very optimistic. They see continued long-term runway driven by, the usual big trends, digital transformation, cloud migration.
Which are still ongoing, absolutely.
Right. And now, layered on top, the increasing importance of observability specifically for all these AI efforts. They feel their platform is really well positioned to capture growth across all those areas.
Okay, makes sense. Let's swing back to the financials for Q1 again. We hit revenue and cash flow. What else should investors be noting down?
Well, billings hit $748 million, up 21% year over year. And remaining performance obligations, RPO, Basically, future contracted revenue grew nicely too, $2.31 billion, up 33% year over year.
That 33% RPO growth is strong. Good visibility.
Yeah, very good visibility. Gross profit was $612 million. That puts a gross margin at 80.3%.
Still very high, but did they mention any pressure there?
They did note it was slightly impacted. Higher cloud hosting costs, which you'd expect with growth, especially large customer growth, and also ongoing investments in new products. So something to watch, but still a very healthy margin.
Right. And operating income.
Non-GAAP operating income came in at $167 million. That's a 22% operating margin.
Okay. And they broke out the AI impact a bit, didn't they?
Yes, interestingly. They said AI native customers represent about 8.5% of their Q1 ARR and contributed about 6 points to that overall year-over-year revenue growth.
So a measurable and growing contribution from that segment.
Definitely. And trailing 12-month net revenue retention remained strong too, in the high 110s%.
Okay, solid across the board financially, with maybe a slight eye on gross margin going forward. What's their outlook then? What guidance did they give?
For Q2, they're guiding revenue between $787 and $791 million. That's 23% year-over-year growth.
Okay.
Non-GAAP operating income expected between $148 and $152 million. Important note there, that includes an estimated $13 million cost for their big user conference, Dash.
Ah, okay. So that impacts the Q2 up our margin guidance a bit.
Right. Brings it down to around 19% for Q2. For the full year, fiscal 2025, they actually raised their revenue guidance.
Oh, interesting. By how much?
Raised it by $40 million. Now expecting $3.215 to $3.235 billion. That's 21% growth for the year.
So confidence in the top line remains very high. What about full year operating income?
That guidance was adjusted slightly. Now $625 to $645 million. Essentially, the slightly lower gross profit outlook we mentioned is being offset by the high revenue expectations. Margin expected around 19-20% for the full year.
Got it. So navigating some margin pressures, but confident in delivering strong top-line growth. Any other sort of financial housekeeping items in the guidance?
A few things. They plan to redeem about $635 million of their 2025 convertible notes in June, mostly using cash.
Okay.
The Q2 acquisitions, EPO and Metaplane, have an estimated GAAP purchase price around $180 million, with about $110 million in cash payments expected in Q2 itself.
Right.
Net interest income for the year projected around $140 million. Cash taxes low, about 1% of revenue. And they're sticking with the 21% non-GAAP tax rate going forward.
And CapEx.
CapEx and capitalized software together expected in the 4-5% of revenue range for the year. Pretty standard.
Okay, so a pretty clear financial picture laid out. Taking all of that together, the results, the commentary, the guidance. What are the key overarching takeaways for an investor looking at Datadog right now?
Well, I think the main message is continued robust growth and clear market leadership in observability and security. That seems undeniable.
Yeah, the numbers back that up.
The platform strategy is working. You see it in the multi-product adoption numbers. That integration is clearly valuable to customers.
And the new products seem to be hitting the mark too?
Definitely. Flex logs, database monitoring. That rapid growth shows they're innovating effectively and meeting market needs. And the big one is the enterprise push. Those large deals, the $10 million plus TCVs, that's a really strong indicator of success in penetrating larger accounts.
Yeah, that jump was significant.
And strategically, their focus on AI observability and security positions them really well for where the market is heading. Yes, there's some short-term gross margin pressure, but management seems aware, and the raised revenue guidance signals strong underlying confidence.
Okay, that's a great summary. Now let's shift to our favorite segment. Time to put on our thinking caps for some outrageous but plausible trade ideas. And we absolutely have to stress, this is not financial advice. Just brainstorming based on the call.
Absolutely not financial advice. Do your own research, please. Okay, my first outrageous but plausible idea, let's call it the Unified Observability Basket.
Intriguing name. Go on.
So we see Datadog clearly expanding its platform, right? Organically and through buys like EPO and Metaplane. The market wants unified visibility.
Makes sense.
So the idea is go long Datadog, naturally, but pair it with a long position in a basket of carefully chosen smaller, innovative companies in niche observability areas.
Like what kind of niches?
Maybe edge computing observability or specialized network telemetry, or maybe advanced application dependency mapping, things Datadog might eventually acquire or partner deeply with.
Ah, so you're playing both Datadog's growth and their potential M&A strategy to consolidate the market further.
Exactly. It's a bet on the whole ecosystem consolidating around the leader Datadog, and capturing some value from the potential targets too. But again, purely hypothetical, massive research needed.
Got it. Outrageous but plausible idea number one. What's number two?
Okay, number two is maybe a bit more tangential. Let's call it the AI inference infrastructure bet.
Okay, connecting to their AI native customer growth.
Precisely. Datadog highlighted growth there, focusing on monitoring inference workloads, not just training. We all expect inference demand to surge, right, as AI gets deployed everywhere.
Seems like a safe bet.
So the trade idea is explore a long position, not in Datadog itself this time, but in a semiconductor company that's heavily involved in producing chips specifically optimized for AI inference.
So not just the big training chip players, but inference specialists.
Right, or companies with a strong inference portfolio. It's a bet on the underlying infrastructure needed to run all the AI that Datadog is helping customers monitor. If inference scales massively, the chip providers for that inference should benefit significantly. It's capitalizing on a macro trend that Datadog's results are reflecting.
Interesting. A pick and shovel play on the inference boom, spurred by observations from Datadog's call.
You could put it that way. Again, not advice, just connecting some dots.
Cool.
Do your own due diligence.
Understood. Two very interesting, thought-provoking ideas there. Well, that wraps up our deep dive into Datadog's Q1 2025 earnings call. We've certainly covered a lot, from the key numbers and growth drivers to their strategy around AI and security and that future outlook.
Yeah, a lot going on there. Strong quarter, clear strategy, but always things to watch, like those margins and the integration of acquisitions.
Absolutely. What stood out most to you listening today? What questions are still on your mind about Datadog's path forward? We definitely encourage you to continue the conversation, share your thoughts.
And please remember, one last time, nothing discussed here constitutes financial advice. Always conduct your own thorough research before making any investment decisions.
Couldn't agree more. Thanks for tuning in to TalkTickers.